We were at a central bank conference in Budapest. And we're on a bus ride back with him, and he starts talking about capital flight if you have a trade deficit or something. So I said, well, what do you mean? He says, well, the capital leaves the country. I said, well, like if you have Joe in New York and he buys pesos from Jose in Mexico and he pays for it with dollars, the dollar account goes from Joe to Jose, but it doesn't go anywhere. It stays at Citibank. And the peso account goes from Jose to Joe, but it's still in Mexico. And I said, with floating exchange rates, nothing moves. You don't get any capital flights. And he agreed with it. It probably registered, but not enough for him to change his narratives when he was in his formal discussions. He was head of the Bank for International Development, I think.
Oh, God, that's worrying.
This is the MMT Podcast with Patricia Pino and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory Podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. For as little as $1 a month, you can get early access to all our episodes and patron-only episodes. A big thank you to all our supporters so far. At the beginning there, you heard MMT founder Warren Mosler, and in a moment, we're going to be talking to him about the recent US inflation figures, Tesla and Bitcoin, currency prices, corporation tax, capital flight, and much more. If this is your first time hearing about MMT, you might want to listen to our first 3 episodes for an introduction, but if you want to dive in here, you're in good hands. In the show notes, I've linked to all of our other episodes with Warren and to some other things that came up in the conversation, which was essentially this month's patron-only Q&A session. I've linked to where you can support us financially via patreon.com/MMT podcast. Support starts at $1 a month, which is 71 British pence at the time of recording. And no matter what level of support you give, you get early access to all of our episodes and patron-only episodes where you can ask me and Patricia and sometimes a very special guest MMT questions. We're 100% listener funded. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about this stuff, really helps too. So thanks for the time you put into understanding MMT. Let's dive in. Welcome one and all to the MMT podcast. I'm Christian Riley.
And I'm Patricia Pino.
And it's an honor as ever to welcome back to the show the father of MMT, Warren Mosler. Hi, Warren.
Hello. Good to be here.
So before we get into any of the audience questions, I think we need to talk about the story of the day that the US headline consumer prices index increased to 4.2%. So everybody's now talking about inflation this week. What does that MMT lens have to say about this? What caused it? Is it best thought of as inflation or a price shock or price shocks or something else entirely?
Of course, inflation is a casual word, the way it's used, right? It's the academic definition is a continuous increase of prices faced by consumers and other agents, businesses in the economy. And so, the question is this a continuous increase now forever, or is it just a one-time adjustment? And, is it the what you call a relative value story, just the market's allocating by price? Something gets scarce, the price goes up, you get more quantity, the price goes down, and that's just how you let markets allocate by price. And so to just use the word inflation without specifying those, we all sort of know what you mean. We had some prices go up, but that doesn't give you enough information to come up with any kind of a policy response if one is needed, right? So it's certainly the problem isn't that unemployment is too low, right? You know that. So we can start with that and then take it from there.
I guess the big question is, how will the Fed react? I know you can't, you're not sitting in those meetings, but if they think, oh God, the economy's hotting up, let's cause a recession. Is the worry, I guess. What are your thoughts on that?
I think there's a good chance, and I was talking to my partner Kareem Basta, who's very good at this. He visits the Fed regularly and people associated with the Fed, and gets a pretty good read on what they're thinking at the moment, recognizing they can change their minds at any time, which has happened to me. I've got some interesting stories about that. But so right now, he's saying that they're not inclined to do anything at the moment. But if they get 2 or 3 more of these kinds of numbers, then they're going to be thinking twice about what they call tightening, which would be to start raising rates, to start what do they call it, tapering on their QE type of things, and to start reversing the tools that they've been applying. So it's going to take a couple of 3 more numbers, and then we'll have a better read on what they're going to do next.
So do they think this was caused by QE?
Yes, they not 100%, but they think it's an influence, and they look at the counterfactual. Without QE, the economy would have been worse, the inflation would have been lower, that type of thing. It's kind of what their models tell them, although they also let on that their models are broken. So, but their models are still telling them that it has some kind of an effect through asset price channels or wealth channels or something. It used to be through lending, but they're not seeing that, of course. So they look at what's moved and say, okay, maybe it's working through that channel, and then do a little research and see if they can find some correlation. And that's kind of what they're hanging their hats on now. Look, the situation is, and it's been this way for 30 years that I've started this MMT thing, that we are the only school of thought that understands the source of the price level. The Fed, the New Keynesians, the Austrians, they do not understand the source of the price level. The Marxists, there's no other school that does that. And you understand the source of the price level, of course. The government is a single supplier of the thing needed to pay taxes, so it's a price setter. That's economics, microeconomics 101. First day, they tell you how a monopoly works. Monopolist has to set price. Doesn't mean he sets the price and it stays there in the market, 24/7. But when he sets a price for his thing, he is setting the price, and that is the price that the market varies around, and that's the source of the price level. The government says we need dollars to pay our taxes, and then it says here's what you have to do to get those dollars, and that determines the value right there. And so inflation being a continuous increase in prices would mean that the government would be continuously increasing what it pays, making it easier and easier for us to get the thing we need to pay taxes. And once you understand that and recognize what's being said, there's no dispute. And so, but again, that understanding has not gotten through to the monetary authorities. Now, look, let me add, it has gotten through on the setting of interest rates. They used to think that was market determined and money supply determined and everything. Now they finally realize they just vote on them. Okay, they're setting price because they are the single supplier of reserves. And I read that as far back as 1988 in one of Basil Moore's books that he wrote with a kind of good friend from the Fed. And, they said, look, we're the single supplier of reserves, so we set the rate. So they understand that aspect of price setting. The other aspect is they're single supplier of what they demand for tax payment.
Okay, so we've got the MMT explanation of the source of the price level. Yeah, so what about this CPI increase of 4.2%? Where do you think?
So, yes, if there's a supply disruption and or weather disruption and the peaches die, the price of peaches goes up. It's got nothing to do with the Fed or anything else. It's called a relative value story. And the price will go up, and then people will plant more peaches, and then when they grow, the price goes back down again. And that's the old markets, allocating by price. It's been going on. People have understood that for thousands of years. That you have these cycles, commodity cycles and everything else, where, supply and demand changes the relative values. But it doesn't change the absolute level of the price level, however you want to determine that. So that's why they call it a relative value story and not an inflation story, and to use Fed speak.
One question I had, because to the mainstream, inflation is always about the money supply, right? And specifically about the base money, right?
Yeah, it used to be, but they dropped that a while back. And now it's just the Austrians, the people who are still in fixed exchange rate paradigm mainly. So there are not too many mainstreamers still on money supply. They look at interest rates because they've tried to come up with a measurement of money supply that would correlate to this type of thing. So they have M1, M2, M3, P star and L and S, all these different monetary aggregates that over the years they've carved out, and they've abandoned all of them as a reliable determination of inflation.
There's obviously a supply-demand thing going on in some sectors of the economy that's caused this thing to show up.
And it does it every day, every minute. It's a continuous resetting. Sometimes the moves are larger than others, and it's a cause for concern. But I mean, none of these prices stay stable for more than a few seconds.
Okay. No. I just remember earlier in the month that, people were talking about, the price of lumber going up and going, oh, this is inflation. It's just basically people seeing inflation everywhere they see a price increase.
Yeah. They're using the word interchangeably for a specific price increase, which is not wrong. That's why I say it's a casual definition.
So without looking at the data and what's actually happening, we have no way of knowing what's causing it.
Right. That's true. Now, what you do know is that if there are people out of work, that we're losing output, right? We're losing real output because they could be working. They're looking for work. They could be producing real output. So we know that's a loss, but we don't know what's causing the price shifts without looking at some kind of data.
So my concern is, and maybe you can tell me whether they are well-founded or not, but my concern is that during the pandemic, it is true that savings increased, but only within a certain section of the population. And actually, quite a lot of people went into quite a bit of debt and they went into financial troubles. And I'm concerned that...
Let me say something about that quickly before I forget. I'm 72 this year, so I start forgetting these things more quickly. So sorry to interrupt. But if you look at the savings going up, a lot of that is because the consumer borrowing has not gone up in the way it normally does. It's been flat to down. In fact, credit card borrowing is down. And so you've got a lot of, and so that shows up as, that's an increase in savings, right? If you borrow less. So most people, when their savings goes down, that's because they borrow to buy a car. They borrowed $30,000 to buy a car. Okay, their savings just dropped by $30,000. So the swings in credit generally determine the changes in savings more than somebody having cash in the bank. Now, this time around, there was cash that came in quite a bit, and especially in the U.S., and a lot of that translated into less borrowing on credit cards, which have high interest rates, right? And so that's, in that sense, so the net worth went up, the savings did go up. But I just want to point out it's on the credit side where you see where the data is.
So it may not relate to additional disposable income. It just means less debt, basically.
Yeah, or they had the one-time income. And so they had a one-time increase in savings. Unless you think the $1,400 is going to be, every month forever, but so far it's not. Looks like it's over. And so they had an increase of $1,400, of income, one time. And they borrowed $1,400 less on their credit cards. The way you know this is if you look at personal consumption, how much people spent. Okay, even though income is way up, it's the only recession we've ever had that's been characterized by income going up the whole time. Every recession we've had has been falling income, which caused the recession. This time we're into recession with rising income. But consumption is down. Spending is down. Okay, well, spending comes out of income and it comes out of borrowing to spend. And if you look at the borrowing component, that's way down. So the rise in personal income has probably mostly offset the drop in borrowing, but not completely because consumption is still, at least cumulative consumption is still down. Monthly consumption is about back to where it was. So I guess you could say roughly now the increase in income from the deficit spending is about equal to the drop in private sector deficit spending, the consumption from private sector deficit spending. See what I'm saying? So consumption hasn't changed all that much from a year ago.
So I guess my worry came in from saying that if, for we've had quite low interest rates for quite some time now, and we know that there is a lot of people in increasing trouble, partly because of the pandemic, partly because of issues that came before the pandemic. But what happens now if the Fed decides to raise interest rates as a result of inflation? Do we have a situation like 2008?
No, I don't think so. I think we're more like a Japan or a European situation where the zero rates are one of the reasons for the lackluster, economy and growth, and also the tariffs, of course, that were in place by Trump everything had started to go bad with the tariffs. Growth had been decelerating. Jobs had been decelerating. Growth of jobs. And then COVID hit. And people seem to have forgotten that we were already had turned corner and headed south. We had a little bit of support from the Trump tax cuts, not much. And then it just collapsed as soon as the tariffs came in. And now Biden's doubled down on the tariffs and thinks they're a good thing. And we got to get tough with China and all that. I don't know. I guess it works politically or something, but it sure doesn't work economically. So I don't think we're in a good place right now. I think these selectively higher prices are draining away more consumer income. It means consumption's going to get hurt because the ongoing income isn't there. We're still way down in terms of total jobs and total employment income. So we're certainly not out of the woods yet. And in terms of people who are hurt with debt, it looks like delinquencies and that type of thing are way down. I mean, and consumer debt is way down, and we're kind of statistically we're at the lows on those types of things. The burden they call it some kind of consumer credit. I forget the word. The debt burden is at a low, and so yes, selectively there are always some people who get hurt by that, and a rise in rates might hurt them if their debt is adjustable rate. If it's student loan debt, the rate's already too high, 5-6%, whatever, but it's not going to go up. So a small increase in rates from 0 to 1% or even 2%, I don't think is going to hurt consumer borrowers all that much. And at the macro level, of course, it helps the economy because the government starts paying that much interest on the $28 trillion of debt that's outstanding of the public, what we call the public debt, which is basic income for people who already have money, of course. And not, that percentage of it that gets spent is not a lot, but it's not zero. So it does contribute that way. And it also contributes to inflation. Forward prices go up, in lockstep with interest rates. Interest rates are forward prices. It's the same thing. And then all of a sudden, consumers and everyone else is faced with a continuous increase in prices equal to the interest rate plus a risk factor for buying things for delivery next month or next year or 2 years from now. So if you're buying a house, for example, suddenly the builder has to pay interest during the building period, has to pay more interest, and the price of the house is going to be that much higher. So you get all these costs from the higher rates that filter into the price structure.
Warren, when you say risk factor, is that basically they put on another margin on top of the forward price in case there's another rate hike?
Well, there's a risk of rate hike, which gives you the yield curve, yes. And then there's the risk that I'm not going to pay you back, right? So if your cost of money is zero right now, your bank, and you're competing with other banks to make loans to me, how low dare you go before you don't think you can make a return anymore? And right now that rate would be probably 3% or something like that for a floating rate basis if I had collateral. So you can recover your costs. Your costs are 1 or 2% plus some risk factor, and then still have a return on investment.
So are we saying that because of levels of unemployment, we know that this isn't about the economy overheating? It's rather, some supply issue. Are we saying this is likely to be temporary then?
Yeah, it is, unless something happens to, if prices go up and then somehow everybody's income goes up by that much so that they can pay for it, rather than just buying less at that price because it costs more, right? But if everybody gets a raise to pay for it, well, now you've just ratcheted it up. And that would be the government itself. So everybody as well. So you've got government pay, everything else. Let's say we get a 6% CPI for the year, then the government gives all employees a 6% increase so they can still pay for things. And that flows through to the rest of the economy, through some channel. Then we're right back where we started from, except everything's 6% higher. And costs are 6% higher, everything is. And we haven't allowed the relative value aspect to play itself out. So, yeah, that's the risk. And that's what's happened in Latin America over the years, where indexation has always been all inflations have always been traced back to that kind of indexation.
to sort of cap it off, what a possible scenario could be, enough of the open market committee at the Fed think the economy is quote unquote overheating. They vote to raise rates because that's what they do. They think they're going to be cooling down the economy, and through the MMT lens, that's going to create, through the interest income channel, income to people, more income to people who already have money, basic income, and so in a way that could end up putting the economy back on its feet for the wrong reasons.
Right, and that's what happened when Greenspan started raising rates and forward pricing channels and cost channels. And so you had, it spurs investment when you see forward prices going up. So you had, some investment. He started raising rates because of his forecasts, and then they turned out to be correct. A year later, inflation starts working its way higher, so they congratulate him for being correct. Well, he caused it, right? And rates kept going up until the budget deficit got low enough to cause a recession. It wasn't the rate hikes that caused a recession. It was a fiscal, response that tightened things up. So, yeah, that's how every cycle's happened so far. The difference now is we've left the rates at zero, so we haven't started the next cycle yet. So look, if they just leave rates at zero and we don't get these increases for, maybe we get them one more time, but we don't get them for 3 or 4 times, then the markets are going to work, and price of lumber going up is going to bring out more lumber, and the prices are going to come down. Unless there's a true scarcity of lumber, which I don't think there is. I think U.S. exports are at record high for one thing, and what we have now are just supply disruptions. Look, the tariffs also had an effect on lumber. It wasn't so much the raw lumber imports, although that was part of it, but we had big tax on furniture, like 25% coming from China. It was buying the lumber, so it's kind of got these strange loops going on where I think that would make the price of lumber go down, but the prices, I don't know. I mean, between the supply disruptions and the tariffs adding to the prices of those types of things, of imported things, and the price domestically went up. And I can't trace it back to the way it was. I try to read the news articles about it, and I can't get to the bottom of all the cross currents going on in the lumber market, including sawmills shutting down, blights in Canada that I don't know. I don't have time to sort it all out. It's not that important to me.
Speaking of things that aren't that important, the value of Bitcoin plunged after Elon Musk announced that Tesla wouldn't be accepting Bitcoin in payment for their cars.
Yeah, it's interesting, the Bitcoin thing, because there's no what they call use value for it. It doesn't get used for anything. All the wire transfers and the money laundering that involve Bitcoin don't require anybody to actually own it or belong or do anything that would make the price go up. They just, and so there's no actual use for it. It's just a certificate that says you solved a puzzle, used up, 3 tons of coal or something to solve a puzzle. And then, and it has value to people who need to be under the radar. So I'll just give you an example now. So let's say I'm a drug dealer and I'm selling wholesale in the States, and I don't want those transactions known to anybody. So maybe I tell my guys I'm selling to, I want payment in Bitcoin. So it goes through some exchange nobody knows about, and I wind up owning it, nobody knows it. Although I understand that it's all traceable, but it's better than just bank account where I'm going to have, FBI agents on me the next day. So, and so I sell it for whatever, 1 million Bitcoin, and it cost me 500,000 Bitcoin to produce it, or maybe even less than that. So I pay my suppliers and my people in Bitcoin, and they sell some to get their money to the extent they're not worried about having money hit their bank accounts. So I'm left with my profit. Well, what am I going to do with it? If I hold it in Bitcoin, I'm relatively safe. If I sell it for dollars or yen or euro, I'm subject to disclosure, right? So I keep it. And or let's say I'm selling products to Europe where there's a 25% VAT, and I'm selling it on a black market without VAT in pretty large size. I've heard that there's 300 billion. I read it actually, wherever it was, mainstream news, that there's 300 billion euro trade surplus. Might not be 300 billion. It might be closer to zero, and that's how much is coming. How many imports are coming in under the table, under the radar, that don't get counted by people trying to avoid VAT. That's a lot of money. So, and so somebody's doing that. Somebody's profiting. Somebody doesn't want their bank accounts to be accessible by anybody, and they wind up having Bitcoin or some other crypto as where that they're getting paid in, and that's driving the price up because somebody has to buy it to give it to them. And there's a limited amount, not that many sellers, and even though it doesn't have any value, like a check that's drawn against an account with no value, let's say. Doesn't matter because you don't have any choice. It's either that or go to jail or worse. And so you've got this whole world of transactions that don't want to be disclosed. And what I think of it as replacing the numbered Swiss bank account. Right? Remember that used to be where all this stuff went. And now the Bitcoin is the new numbered Swiss bank account, except it doesn't have any intrinsic value or any use value. But it doesn't have any sellers either. It just has buyers because, going to jail is worse than, is a bigger, larger risk than getting nothing for your Bitcoin. So, and so the buying is just incessant. It doesn't stop because the amount of money that's, let's call it money laundering, for lack of a better word, just keeps growing. That amount that's, the lawn that needs to be laundered keeps growing and growing and growing indefinitely, as long as there's laws in place causing people to pay that price to be to hide. So there's ultimately nothing there. It ultimately goes to zero. But in the meantime, that type of buying can drive the price up to anything. I don't know how big the float is of profits that need to be kept secret.
At some point, they've got to take that money out, though.
Well, that's the thing. They just never do. They only take up a small amount to maybe buy a car or something, or
not a Tesla anymore.
Yeah, buy a Tesla, pay their suppliers, and then but then the profits keep coming in as long as VAT tax is there, as long as drugs are illegal, as long as there's dirty money to be made. This is the place to keep it right now. Every exchange they've broken into has been all money laundering. It's all they ever find when they break into these places.
So what could trigger a sudden collapse in the price?
Well, if they changed the laws and made all this stuff legal, then nobody would do that. But I don't see that happening. If they eliminated VAT in Europe, I don't see that happening. If in Venezuela, if you're selling oil because you're an insider in a state-owned oil company, illegally, and you're getting paid in Bitcoin, it's going to take somebody to stop that from happening, right? Now, there's probably so much of it that if some of it was stopped, or if it stopped growing, it would probably reverse quite a bit. The total flow would go down. But it's still going to be there as long as there are buyers who have nowhere else to go.
And is inequality conducive as well to an increase in Bitcoin transactions? Is there tax avoiders there?
If you call them the amount in Bitcoin as wealth for your inequality issue, yes. If you value it at zero, probably no. So, how do you value it, right? Where you can sell one Bitcoin or where you can sell all the Bitcoins? If it's where you can sell one Bitcoin, yeah, there's inequality. If it's where you can sell them all, it's where zero. It eliminates a lot of inequality.
So let's get into these audience questions. Patricia, have you got them in front of you?
Yes, I do. So the first one is by David Murray, and he speaks of something that we just discussed, actually. So he asks, has the increase in money supply over the last 20 years devalued the pound? Does QE affect the currency value, or does the fact that it is an asset swap means it affects it less?
Yeah, I'd ask the question the other way around. Does what he's saying, the pound has dropped? Because it's gone up recently. But so as the drop in the pound, did the drop in the pound cause the money supply to go up. I think that's probably more likely that any inflation you might have had results in a higher money supply, because let's say you have 100% price level increase, everything doubles. And now you've got this, but you have the same net financial assets on it. Same, depends how you measure the money supply. Let's just say net financial assets right now. It's one measurement. Well, then, people only have half as much. They have the same amount of cash in the cash register, but all the prices in the store have doubled. They don't have enough cash anymore, right? Or if you're a business and your payroll and everything else is doubled and you have the same amount of cash, well, you have half as much. And so you now have to take measures to increase your liquidity by borrowing or selling equity or something. And the whole economy can't function without some ratio of liquidity to total assets. So if your total assets are going up nominally, sure, your liquidity has to go up nominally, or you can't function. So it's more like the inflation causes the increase in the money supply than anything else. That happened in the Weimar Republic. I did that paper with Phil. And the inflation was so strong that suddenly the money supply was way too low. And the economy was shutting down because of a lack of money supply. People couldn't make change. People didn't have liquidity to pay their payroll and their businesses, because however many marks they had now wasn't enough for a cup of coffee, right? It used to be enough to make their payroll. And so they were like literally printing as fast as they could, the central bank. But in addition, they gave private companies the license to print marks, and they didn't have to pay for them or anything. You could just print them and spend them. Okay, you were just literally allowed to print them and spend them to try and keep up with the inflation. It wasn't causing. People thought it was causing inflation. Now all the research shows it wasn't causing that, just to keep up. And they couldn't print them fast enough to keep up with the inflation. And so there was like a money shortage the whole time, which is kind of interesting. So even when they legalized printing, there still wasn't enough because the inflation was large. Of course, it was large because of the government paying ever higher prices for foreign exchange and other things they needed for war reparations. But that's another story. So the point is, though, that the inflation causes the money supply is a function of the inflation, not the other way around. To answer that question.
Yeah, so in the mainstream, you always get given these plots of money supply and inflation as sort of proof that the money supply increased inflation, but is the money supply lagging the other, right?
Yeah, and that would be for today's floating exchange rate regimes. If you have fixed exchange rate, then the money supply is the reserves, and so then if you double that, then it is the cause of inflation because it's the value of it's a devaluation of the reserves. So, but none of that's applicable right now, except in Bulgaria and Hong Kong.
Right. Are they the only two fixed exchange rate currencies around these?
There are a couple others. There are a couple of dollarized places like Panama and I think Venezuela might have dollarized. I'm not sure, but I don't keep up with them either. But there are a couple of dollarized places, but I think there are only a few fixed exchange rates around.
So just to go over David's question then, so has the increase in money supply devalued the pound? I'm not sure that he was asserting that the pound has devalued.
A devalued pound, or let's just say inflation, which would be internal devaluation, right?
Yeah, right.
A devalued pound would create, would lead to an economy with more money supply. Depending on the definition of money supply. I don't use that word either, but just the casual use.
So really, the money supply doesn't really tell you a lot with floating exchange rates.
Yeah, it's a residual.
So the idea is, actually, John Harvey wrote a really good thing in Forbes. It's pretty snappy and short, and it's just titled "Money Growth Does Not Cause Inflation." Okay,
well, just send him that, and then I don't have to answer the question.
No, but he's basically saying, that the quantity theory of money accounting identity, MV equals PQ, he's saying, well, obviously that's not untrue. It's just the assumptions put on it that, if V is constant, velocity is constant, and Q is constant, then an increase in M will result in an increase in P. But those assumptions are not valid. So that's another way to sort of skin that cat. But and then he says, does QE affect currency value? And really, with MMT, we're saying, the thing that changes the price level is when the government, the issuer of the currency, pays more for the same thing today than it did yesterday.
Certainly not dollars shifting from reserve accounts to securities accounts,
which is what QE is. Yeah. But then he caps off the question with something that's kind of adjacent to the question, which I think is worth talking about. He just ends by asking, for example, what makes £1 exchange for 150 yen? That's a big question, I guess. But
well, it's market forces, of course. It's because it's as close as you're going to get to a free market, and with millions of transactions every minute, probably, and they're all voluntary. Yes, I know. And right now, there's no intervention going on, central bank intervention. And so you wind up with purchasing power parity over longer periods of time as a pretty good indication of where the currency values are. Sort of like the Big Mac index, that they've had.
Is this law of one price thing, isn't it?
Is that what you call it?
Well, the parity thing, I think that relates to interest rates. Maybe I'm wrong, but...
Yeah. Well, with interest rates, that works with fixed exchange rates. But with floating exchange rates, it's not a direct force like it is with fixed exchange rates. But with floating exchange rates, it's whatever an hour's worth of labor cost in the UK in pounds, that'll be how many pounds it would cost in Japan for an hour's worth of labor, plus or minus differences in the institutional structure.
So is it this idea that an item, say a Big Mac, should cost the same regardless of the country that you're in once you take into account the exchange rate?
That's right. And so you might have taxes or something like that, or cost of preparation, a little bit in there figured in because you have different, wage structures in an economy. But a lot of times that over long periods of time, that seems to sort itself out in terms of the exchange rate. And they call that purchasing power parity. So they have measures of the purchasing power, what a pound can buy in the UK and what a pound can buy, or what a yen can buy in Japan, or 150 yen in Japan. And then over time, that seems to, explain the exchange rate.
Okay, so we could just move on to this next question by Robin Beaumont, and it's related, I would say. Robin says, at the moment, there are increases in minimum wages happening in the UK and New Zealand, around 2.2% and more for New Zealand. I remember listening to a discussion with Warren about a nurse and whether or not the pay rise was actually a pay rise. And then he says, so when pay is pushed up by government policy, then all businesses in the private sector adjust accordingly. And then they either push suppliers to keep prices down to negate the extra overhead, accept the drop in profit, and or make internal cuts, or they push the pay rise onto the customer in the form of increased pricing. So he's just positing these things. He's saying the last one is just an inflationary effect that negates the pay rise. Surely, he's asking. And then he's saying the middle one is negative on expansion and employment. And then he's positing the first reaction is causing problems elsewhere and perhaps reducing the quality of the product eventually. So there's a lot to that, and then he caps off the question by saying, does globalization mean that a pay rise in a developed nation can actually affect the livelihood of a worker in a developing nation? So there's a lot there, but, dive in anyway.
To answer the last part, it doesn't need to affect the developing nation because they have their own, currencies, and they can have their own policies and their own distribution of wealth within their country, so it shouldn't matter what anybody else does. But I would say it doesn't matter unless they let it matter. So they have the option to be insulated from that. But if we increase the minimum wage in the U.S. from $7.50 to $12, how many people would that affect? Not a lot, okay, because most people are getting effective minimum wage in most of our large businesses is $12 or more, sometimes 15 or 20. So it's just going to affect people marginally around the edges, the economy marginally around the edges. It's going to help. It'll be millions of people that will get help, but it's not a whole lot of new dollars in the economy, and it's not a whole lot of cost for businesses. So there might be selective businesses where it costs. So maybe people picking fruit have been victimized and they're only getting $7.50 an hour, and they're going to get 12. So that might marginally affect the price of fruit. But in the U.S., if you look at the price you pay for food and the labor content for something like that, it's very small, the labor content. So it wouldn't materially affect anything, I don't think. So right now, the minimum wage is far enough below the wage that most companies are paying as a minimum wage, and there are few enough people getting it where the increase is going to help a lot of people without having much of an effect on the economy. And a lot of our cities have shown that. You hear anecdotally, Seattle has a minimum wage of $15 an hour or something, and it doesn't affect them all that much. And so they rushed in to try and find some negative effects, and I haven't seen any found it. And they even tried to show that the high wages of keeping people from going back to work, and that didn't. They haven't been able to show that either.
So really, that middle option, which is he was saying, the last one they pushed the last option they pushed the rise the cost onto the customer. That's unlikely, is what we're saying here.
Yeah, there'll be some of that around the edges, but it's not going to be a major thing. So let's say you raise it to $12, and you can detect an effect, and you don't like it. Okay, so you don't do it again, but you haven't really. What have you lost? Who's the worse off for it? Some restaurant that now has to pay a server $12 instead of $7 or something, and so the price of the meal went up 25 cents. Okay, so now, we won't do that again. Fine. It's not like there's been some catastrophe, to the economy or the country or anything. It's going to be a very, very minor effect, and you don't have to do it again. It's not like if you do it once, you have to do it every year. If it's not working, stop doing it. But chances are it's not going to have any negative effect. It's going to be a lot, very, very helpful with regards to social equity and exploitation. And those are important values with trivial economic costs. So we'd probably decide to do it. I mean, I'd do it. I don't think there's any risk to it. Now, would I go to $100 an hour? No.
Yeah.
Right? That's going to have
all at once.
Yeah, right. I mean, that'd be like in my mind anyway, a very disruptive thing. And there are people saying, "Good, we need to disrupt capitalism." It's like, okay, but that's a different argument.
Yeah. So basically, yes, please let's raise the minimum wage. Let's not listen to the doomsayers.
Yeah, let's find out if they're right. And if they are, then we promise we won't do it again. Okay, how about that?
Yeah.
But look, if we go to a job guarantee, we don't need a minimum wage increase.
Yeah. But they'll complain about that as well.
Right, but if you raise the minimum wage, does that mean we lose political momentum for a job guarantee?
Well, I always think, if you've got people who are, fight for 15 or whatever, raise the minimum wage, it's a great in to talk about the job guarantee. It's like the only way you can guarantee people will actually get the minimum wage is to implement a job guarantee and pay that wage.
Plus, what you save in enforcement and compliance costs, more than makes these are real costs, because these are people that are tied up doing that kind of stuff instead of curing cancer, right? That you get right away. So that's like a big real savings to the economy that improves all the well-being. So yeah, anytime you can replace a bureaucracy with a policy that, like a job guarantee, it's fantastic.
Yeah, and there's another thing that I haven't talked about enough or appreciated enough, which is the idea of the NIBUR, the buffer stock of employed workers. If it's functioning, it's going to be way smaller than a buffer stock of unemployed workers that we use at the moment.
Exactly. That was the whole imperative back when I first wrote it up. soft currency economics in 1992, that you can have a much smaller buffer stock and it's more effective.
Exactly. Yeah. And so you are even there, if you're looking at the transfer payments from the government to the people in either buffer stock, because the employed buffer stock is going to be that much smaller, it's cutting costs way down, even though as individuals, they're getting a much better pay.
Yeah. Now, and, look, with the labor buffer stock, the government is in some level getting value for money. So it's defining its currency. You have to at least show up for work. You can't just do nothing. So it's setting it at some measure above zero. Whereas, unemployment compensation, it's not. And that's why they have to limit it and force people off and do all these other things. Otherwise it becomes UBI and the currency fails. So it's a very fine line.
So P, let's move on to Ted's question.
Yeah, so Ted Tripp asks about Biden's State of the Union speech. He says he proposed raising taxes on wealthy individuals, and I suppose all corporations. I recall Warren stating that corporate taxes are unnecessary, that individual income taxes would do the job. This makes sense to me, but are there any arguments in favor of the corporate tax?
Not that I know of, because they're passed through to the consumer. And so in that sense, they're generally regressive. Now, if it's a corporation that builds super yachts, okay, maybe that should be taxed, or maybe they shouldn't be allowed to do it. So anytime you can justify a corporate tax because it's not, it's a progressive type of thing where it's providing goods and services only for the highest income people, then you're begging the question, why are they even allowed to do it? So because it's distorting their consumption thing. So the point is, does it reduce aggregate demand? Why would you raise taxes in any case? And it would be to reduce aggregate demand or to change behavior. But let's just say to reduce aggregate demand because you're afraid that there's too much spending and it's causing inflation. Well, taxing the rich doesn't accomplish that. So or taxing corporations doesn't accomplish that. So I wouldn't tax for that reason. And if you're worried about inflation, then higher corporate tax gets passed on to the consumer, so it shows up as at least a one-time adjustment, higher prices somewhere. Not the first day, but within some period of time. So it's kind of counterproductive.
I presume the focus of this is more about the inequality as a means to tackle inequality.
Yeah, well, a corporation's not an equality thing. It's just a piece of paper. Now, if the inequality is the shareholders or the officers you think are getting paid too much, that's kind of a different issue. A higher corporate income tax doesn't mean the CEO is going to take a pay cut. So, it means prices are going to go up. So I don't. It doesn't accomplish what you want to do, and it makes a lot of people angry. It burns up a lot of political capital, and you're tying up Congress for months and months and months when they could be making other. They could be talking about a job guarantee or Medicare for all. Instead, they're talking about this corporate tax that's not going to make any difference anyway. And the income distribution issue, I think, is always best addressed at source. Don't let the income be earned to begin with, rather than let it be earned and then try and take it away. And so I think the zero rate policy, which I've been proposing for a long time, has already kind of bent the curves a little bit. Nobody's talking about it, but the last few years, when I see these graphs on income distribution, it looks to me like it's flat. The difference has flattened out for the last 3 or 4 years while we've had these zero interest rates. After a few years of zero interest rates, it started kind of working its magic. And nobody's talking about that. But it looks like it to me when I see these charts. And you can take a look at the next one you see of longer-term income distribution charts. I think the zero rates have definitely worked against it. So we have the permanent zero rates. We stop the Treasury from issuing anything longer than the 3-month bill, which is basically money or cash. And so get rid of all the bond traders and that whole cottage industry. I'll have the Fed allow unlimited overdrafts and reserve accounts so we don't have to have a whole interbank trading industry of these highly paid people. So there are ways to address the distribution of income as source like this. Have you heard my idea on the stock market?
Yes, we talked about that with Phil, yeah.
So that's another way to get rid of this distribution issue at source. You get rid of all the income being distributed to traders. So we can shrink the financial sector from I don't know how large it is, 25, 30% or more of GDP down to 4 or 5% just to accommodate transactions. It's a massive increase in real wealth, and it can all be done. It only exists because of institutional structures such as tax advantages for not spending your income. If money goes into your pension fund, it goes in pre-tax. Without that, maybe people wouldn't be doing it. Maybe there wouldn't be these $60 trillion being managed by, money managers who are distorting the income distribution scale just on their own compensation. And all the bank departments of private equity, private wealth departments and all that. That can all go away, right? So, and that's because they're all protected under these tax advantage plans to not spend income, which is, I think, my sixth deadly innocent fraud. We need savings to have money for investment. It's just not true. So it's all there on a misunderstanding. It's created this massive chunk of the financial sector. All the compliance costs for income tax, it's probably 10% or more of GDP. A friend of mine at the University of Chicago said it was 15. And so maybe he's right. And that's real wealth. So if all those people start doing something else that's actually adding to real wealth rather than just digging holes and filling it in for vast salaries, and let's say they're in public health or they're in education or something else, those are benefits that the lowest income earners would share in disproportionately because the highest income earners already have all that stuff. Okay, so whose children will get the benefit of all this addition to public education, public health, and everything else? It's going to be the lowest income earners. So you just with one stroke of the pen, so to speak, eliminating between the finance, insurance, and real estate, between the financial sector and the compliance costs, 35, 40% increase in real wealth, which would mean the lowest, almost 100% increase in real wealth for the lowest income earners, at least 50 or 60, maybe 100. That's like enormous. That's where their standard of living is draining off to. It's not going necessarily in one guy's pocket. It's going to this team of legal experts that JP Morgan's spending money on for compliance reasons. And they're budgeting $10 billion a year or something for legal, right? For compliance and for record keeping and for accounting and all this stuff that doesn't have to be done anymore. All those people would instead be producing services that are going to benefit individuals, and that would be disproportionately to lowest income earners because they're the ones starved for the services, and the highest income earners already have a surplus of those services. So it's just such an easy thing to do, and it's there to be had. And it's all there. This bleeding off of real wealth from the lowest income earners has been done by the institutional structure that Congress keeps approving under the myths of the 7 deadly innocent frauds.
Can we just drill into the idea about corporation tax? Because I know it's kind of a hard one for progressive people or people to the left of center to sort of take a stand on, because we all associate with people who are like, yeah, God, if only Starbucks paid their taxes, or if only Amazon paid their taxes, but we need a crisp kind of talking point.
So who pays the Starbucks taxes? If all the coffee shops had to pay more taxes, then a cup of coffee would go up, number one. If you just have selectively, they're all using tax shelters in Ireland or something like that and you want to increase tax compliance of corporations, where some are paying their 20-something%, some are not, and you want to change things so they all are. And let's say it doesn't result in a price increase. Well, what is it going to result in? It doesn't mean that the government has more money to spend. It already has infinite money to spend. The question is it creating anything more for sale? Is it reducing aggregate demand? And it's not. You can't trace anywhere to where that's reducing aggregate demand. The corporation pay that much more in taxes. And so I'm not against it. I'm just saying it doesn't accomplish what these people on the left are attempting to accomplish. It's not like it's us against them. A corporation is just a piece of paper. You're fighting. And so is it, you just want to be on record as having beat the corporation, regardless of what it's done to anybody's standard of living or not? I don't know. I'd like to think larger than that. But if it's just a narrow ego thing, okay. I mean, you can't argue with that. I guess they can call it a victory. If you heard me talk about the game you play as a kid,
No,
go out and try this. It's called Who Can Touch the Other Person the Softest.
Oh, right.
Right. So I go first. I say, you go first and you touch me soft. And then I just hit you in the mouth full on. And I say, okay, you won. Well, you did win. If that's important to you to have a victory, I'll play that game all day.
Yeah, I've if you're using the old or the non-MMT paradigm to look at it, you think governments have to get money from somewhere to spend, and you see the bottom line of huge corporations going up, then you think, yes, it would be a good thing. And obviously Bernie Sanders is on this tip all the time, isn't he? We're gonna get the money from the mega corporations, and we're going to use that to fund the Green New Deal, and we've talked about that ad infinitum. But I think I've heard you say previously, corporation tax is a pass through. Have I said that right? And that basically it just means that if you raise corporation tax, the prices of what they sell are going to go up.
Yeah, and it's not 100% in every industry, but it's a general understanding, and there are exceptions. Like it's a government contractor, then they just pass it through the government. It's probably in the contract.
Right. Okay. But is that kind of is that just sort of widely accepted? I mean, are there studies that back that up, or is it just something that?
Yes. Well, it has to be. It's just an accounting, right?
Right. Okay.
So there's a cost of capital, and people will invest based on a certain return, based on the price you're selling your product for.
Yeah. So it's not the case that Elon Musk's going to go, listen, guys, I've got this. I'll pay that extra.
Right. He wouldn't do that, but it would happen indirectly through market forces over time.
Yeah. Right.
But again, even if they did pay and prices didn't go up, doesn't mean anybody else's taxes will go down or don't have to go up, because unless it drops aggregate demand, then there's no indication that it drops aggregate demand. It doesn't cause lumber prices to come down because Tesla paid more in tax, so now they're not buying as much lumber. Unless they decide not to build a factory. Of course, that works against every growth model we have, but I don't think that's why they're raising corporate taxes, to keep them from investing and expanding. That doesn't make any sense.
Here, there's quite a big campaign to make the likes of Amazon and Google pay their corporation tax, and for all these reasons that we've been discussing. But if we're saying that they'll simply just increase prices as a result.
Yeah, well, why aren't they paying tax? Because they don't have any taxable income, right? Well, who determines the rules for taxable income? It's Congress. Where did the IRS forms come from? They come from the government. They can change the rules. They can change the form if they think. Not that I would do it. I just have zero tax. Then you don't have to worry about it. We don't have to waste our time on this discussion. We get on to like Medicare for all. We're probably not going to get to Medicare for all because we're talking about this corporate tax thing. That's another cost of this whole thing for nothing. It's totally for nothing.
Yeah, that's why I wanted to just get the crisp sort of response to that so that we could just end the conversation. And
so look, Amazon has the same corporate tax rate. They fill out the same forms as the grocery store or whatever, and they pay less tax in the grocery store because certain things are deductible from their taxable income, like investment. Well, maybe Congress shouldn't have investment deductible. Maybe they shouldn't have software deductible or something if they want them, whatever. But these are the people. How can a senator be calling for this stuff without? He should be saying Amazon should be paying more. He should say we need to change what's deductible for corporations, right? Or we need to change this instead of just demonizing a corporation that's following the rules that they set up. It's just like disingenuous. I don't like it when they do that. If they don't like the rules they set up for taxation, and fine, but then don't demonize Amazon for trying to go to the lowest tax place and make a deal with localities. You're the one who set it up, so that's how they benefit. There's no natural benefit from doing that. It's a benefit because of the laws and the institutional structure set up by Congress. So take responsibility and fix it.
And when they don't fix it, obviously, municipalities and even countries fight to give them the better deal. Do you know what I mean? They you know, that I know in the States you have, you know, states sort of, you know, trying to outdo each other to do favors for the corporations. So
yeah, well, look, the big problem in Europe with levelized taxes, right? We've got the same thing here with our states, not as bad as in Europe. We do.
So it says here, just for some more info, it says here that Amazon said that its tax bill had been offset by government incentives related to the investment in infrastructure, as it caters to soaring demand for home shopping and IT services. So are we saying it would be better just to tax Jeff Bezos and to obviously make them pay their workers better? People here, obviously, they are concerned about the soaring profits of Amazon, even as, you know, their reputation for treating their employees is quite bad. Would it be better to just ask them to pay their employees better wages and also to tax Jeff Bezos individually?
Okay, so he's already taxed the individual the same way anybody else is. You know, if there are government incentives for investment that lower your tax bill and he's doing that, then get rid of the government incentives for doing that if you don't want him to do it. Okay, so if I start a company and put money into it and it fails, that's an expense. That reduces my income. And so I make $1 million this year and I spend $1 million on a new company that I think is going to do well, and it fails, and I lose $1 million, the government says, okay, well, you don't have to pay taxes. Well, you can change that law. You can take away that incentive to invest in a new company if you want. But don't look at me and say, hey, you made $1 million, you didn't pay any taxes. That's not fair. It's like, I was just obeying the law that if I invest and it fails, then I can total my income for the year. I made $1 million here, I lost $1 million there. So I have no net income, so I have no taxes. If you want to put taxes on your gross income, if you make $1 million here and you lose $1 million there, well, you still have to pay taxes on $1 million. Okay, go ahead, Congress, put it up for vote and run for office based on that. But don't come after me for following your laws and policies. They're like passing the buck on to people. They put these laws in place and then, blame people for following their laws.
Yeah, I think the way it comes about is what people see are the optics, which is Amazon have a bad reputation for, overworking people.
So why doesn't Bernie Sanders get up and say, look, they're just following our laws. We need to change our laws. It's not their fault. We put the law in place. Here's my proposal to change the law. Okay, the minimum wage needs to be higher. You don't demonize a company who's already paying double the minimum wage because they're not paying enough. We raise the minimum wage, or we put a job guarantee in place. Then they'll have to do it. You don't go after companies who are law-abiding, I don't think, which is what Trump was doing. He was politicizing the whole thing. And I was just categorically against that. It makes for a bad society to have the government, instead of putting laws in place to make things happen the way they want to, put ridiculous laws in place and then start, demonizing companies that follow their laws. You're just setting people up. I just don't like that at all.
Okay, well, we'll just move on to this question by Rory O'Brien. It's kind of adjacent to what we've been talking about, tax shelters and things like that. So he says, a question about offshore bank accounts, capital flight. Is it correct that all electronic pounds are effectively in a giant spreadsheet regulated by the Bank of England? Some of these pounds are called reserves and are literally managed by the Bank of England. The rest are the entries in our regular bank accounts, which are managed by the licensed banks. The government gets to adjust the overall net total on the spreadsheet by spending or taxing, and the banks get to create equal and opposite entries when making loans, which create positive balances in some accounts, but do not increase the net total. Obviously, he's talking about net financial assets there.
Right, of the private sector.
Yeah, and then whatever transactions are made, they are regulated penny for penny, and every electronic pound in existence is accounted for and potentially trackable by the Bank of England. And so he's asking, is that true?
Well, it's true for bank accounts.
Yeah, sure.
Bank of England's a bank and has accounts like reserves and whatnot. And the commercial banks are members of the Bank of England. So it's all directly or indirectly under their control. But if you go out to dinner and you have a check, you got to pay, £50 or something. That's, some people will say that's money, right? It's a receivable for the restaurant. It's your payable, and you could, the restaurant could sell that to somebody else. Let's say you didn't pay, but your credit was good. They could sell that to somebody who would then collect it from you, maybe a collection agent. And so, it depends on your definition of money. So it sounds like he's defining it as bank accounts. So his bank accounts, yes, it's correct. Now, the one thing I would say is that what banks do to increase balances in their bank is they buy things. So the bank can go out and buy pencils and pay for it, and then whoever sold the pencils, their bank account number would go up, and the bank's capital account would go down. Or if the bank lends you money, what they're doing is you're signing a note to pay, over time, and then they are buying that note for you and paying for it with pounds. So it all falls under bank spending, and with lending being a subset of spending. So it's always a bank purchase. So the Bank of England will purchase securities, or the Bank of England will pay somebody for their labor or something like that. And credit, or they will buy a promissory note from a member bank, a loan, a book a loan. So it's always a purchase that creates a deposit. So bank purchases creates a deposit.
Loans create deposits, yeah. And so what he's saying is, if that's the case, it seems like there is no such thing as an offshore bank account.
So you can have non-member banks, or not part of the Bank of England. I can set up a bank. I can call myself a bank, and just use a Google spreadsheet or an Excel spreadsheet or something. And I say, okay, Christian, give me £100 and I'll mark it down in your account. You give me £100, send it to my account at Barclays or something. And I say, okay, now see here on my Warren Mosler bank here, offshore bank, you've got £100 credit. So that is yours. Or I can make you a loan. You want to borrow £100? Okay, I'll credit your account at this Mosler bank for £100. And you say, okay, great. What can I do with it? Can I move it to another bank? Well, no. How would I do that? I'd have to have £100 at Barclays. I'd have to shift it from my account to your account. Before I do that, I want some more collateral. Meanwhile, it's on my books. So meanwhile, it's an offshore account. And so you've got £100 on my books because I paid you something. Let's say I paid you for this interview. And I just credit it to my account in this offshore bank. And that's your deposit at the bank. Now, is it any good? Oh, I might have a lot of capital. It might be good. It might be a spreadsheet I keep that is guaranteed by my financial business. So it may be good. But it's not on the Bank of England. It's not anywhere. I just paid you. Nobody else knows about it except you and I. It's on my spreadsheet. And I can call it a bank if I want to. It's offshore. I don't have any regulation. It can be in the Bahamas. It could be anywhere.
Does it need to be in a foreign currency to be?
No. It can be pounds. It can be dollars. You give me yen. Okay, I've got a yen deposit for you. Right? Yeah, I'm holding it for you. It's good. Now, you might not like the idea. You've got to decide whether you want to do that. So what happens is, what you have is, you have like Citibank had Citibank London, which was an independent company that wasn't even guaranteed by Citibank. Well, it might have been at one point. And they had loans and deposits on their books in their London office. And because it was in London, they didn't have reserve requirements at the Fed back when there were reserve requirements. So if I wanted to deposit $100 at Citibank New York, I might have gotten 3% interest. And if I wanted to do it at Citibank London, I might have gotten 3 1/8. And the reason was they didn't have reserve requirements, so they passed through that savings to me. And so people who felt okay about Citibank, even though it was London and maybe had some capital, but not a lot, because they thought Citibank was always going to be good with it. They had billions and billions of dollars in those Citibank London accounts, and that was an offshore account. So those were the euro dollars, and all the U.S. banks would offer euro dollar accounts. Bank of America, Chemical, all these banks. Handy, you have euro dollar accounts. They all traded them with each other, and corporations would borrow them and lend them because they didn't have Fed reserve requirements. They were outside of the Fed system, and they were in dollars.
Just to add that's the definition of a euro dollar. It doesn't. It's got nothing to do with the euro. It's basically a dollar-denominated financial asset that's not regulated by the U.S. government, basically.
Yeah, and they would have higher leverage there. Citibank might be leveraged 25 to 1 or 50 to 1, where they're in capital. So if they had $1 million in capital, they might have 50 million of loans and deposits. Whereas in the States, they couldn't do that. Maybe they're only allowed 10 to 1. So they kept large books on these Eurodollar accounts, offshore accounts, because of the leverage possibilities.
The risk you're running there is that that you're banking these assets with people that can't insure them, really, right?
Well, they were Citicorp would guarantee it, not the bank. The bank belonged to a holding company, and the holding company would guarantee the offshore branch. So they had capital. Not as much as the bank, but they had capital.
Yeah. But it would be possible, like, to have a genuine...
Oh, there's no FDIC insurance, right?
Yeah. So it would be possible to have a genuine run on those assets, right?
Yeah. But, the banks had to pay for FDIC insurance. And so because they didn't have to pay for it, you'd get a higher rate. But yeah, sure, he could have a run on them, and then Citibank would have to borrow the Eurodollars from another bank to replace it. And so there was a massive Eurodollar trading market.
So there is such a thing as offshore bank accounts.
Yeah. And look, you can borrow money from an offshore bank. And for all practical purposes, it'll be just as good as anywhere else. But you still have to borrow it. You still have to be able to pay it back. They're still going to want to make sure you can pay it back, just like any onshore bank. If it's buy a house, they're going to want a first mortgage. If it's for a car, they'll want the title. Functionally, it doesn't make any difference that I've ever been able to tell, except it allowed banks to run at lower capital ratios. And we had a guy down here, Stanford, who had a big offshore bank in Panama or something, had several $1 billion, and it failed because the loans that he made with the deposits didn't pan out. So the depositors took a lot of losses because they weren't insured.
When people have an offshore bank account, we're told people want to put their money beyond the tax man, somewhere where the tax man's not going to find it.
Yeah, remember the numbers? Do you remember the numbered Swiss bank accounts?
Yeah, right. Okay.
It's the same thing.
Right. Okay. So that does happen. So obviously, obviously the MMT lens says, look, we don't need that money to be able to. We don't have to go over there with the pliers and pull that money out of people's hands to be able to fund the NHS.
Yeah, that doesn't mean there's less money in the UK and it's hurting the economy.
Yeah, right. Okay.
Loans still create deposits where it's not like they're taking money out of one place and putting it in another. So, Varoufakis had that problem in Greece, and when the Greeks shut down, the government shut down the Greek banks. It wasn't the ECB. And because they were afraid that the euros would leave Athens, and then there wouldn't be any money to run the country. It's like, that's just nonsense. So they just don't understand how the monetary system works. So if you're in Athens and you move your money from the National Bank of Greece to Barclays, your euro, and you're still living there, you still have your money to pay your rent, right? Okay, on some level, you could say the euros left the country, sort of. They just went from one spreadsheet to another within the ECB system. But it didn't affect the residents of Greece, their ability to spend in Greece. It had nothing to do with it whatsoever. But he didn't understand that, so they shut the banking system. So it wouldn't happen.
So the end of the question by Rory is just basically he's asking, so is there really such a thing as an offshore account? Well, yes. And then he's asking, and what form, if any, can capital flight take in monetary terms?
Capital flight is when the holder of an account, let's say at the Bank of England, the name changes from somebody who's a resident to somebody who's a non-resident. But so you might have £100 at the Bank of England, and you send it to me or something. So now the £100 goes from your account to my account. And you and I wouldn't have accounts at the Bank of England, but we would have it at, let's say, Barclays.
But it's still at the BOE.
Yeah, but it stays. The accounts at the Bank of England stay there. They can't transfer to any other bank. The accounts of the commercial banks can be transferred to each other via the Bank of England. So the Bank of England facilitates that. So the pounds go from one commercial bank to another, or they stay at the same bank and the owner changes. So if there's only one commercial bank in the system, they couldn't go anywhere. If you sold pounds and bought yen, somebody in Japan owns pounds. He has an account at the bank that you had, and you have yen at his bank's account. Now, if there's more than one bank in that system, it can go between different banks within the domestic system, but it can't go outside of it. There is no such thing. Now, with fixed exchange rates, capital flight was when the reserves moved. So if the Bank of England had gold and the gold moved out of the Bank of England to the Bank of France, then you had capital flight.
So you had to convert your reserves into gold before you transfer them out?
Well, we don't have that anymore. But, the reserves were convertible into gold. But the reserves would still be at the Bank of England, but they might go to somebody in France. So it goes from Peter in England to Pierre in France. Pierre now has the convertible pounds at the Bank of England. And unlike Peter, he says, I want my gold. And now the gold has to go to France physically as he cashes in his account. But that's been gone for a very, very long time. But that's where the idea of capital flight came from.
But now there is no escape.
No, what happens is now, the 100 pounds goes from Peter to Pierre, but it stays in the same, right where it was.
I think the reason these questions come up is because, again, it's, when people are, pushing for their progressive policy proposals, there is that pushback from the status quo elements of the debate who are like, well, if we do X, there'll be capital flight.
Yeah, they don't stop there, though. They say, well, if you do X, then you get capital flight, and then this gets done, and the pound goes down, and then you have inflation. They've created like this string of 8 different things. And so if you don't realize the first one is wrong, and you don't go back far enough, well, then and it's allowed to stand, well, then it moves on to, that becomes part of the argument that everybody assumes is okay. It's like when I was talking to Steve Keen about how imports get paid for or something. The seller sells it, and then the Bank of England converts it, and then this happens. And I go, wait a minute, let's start over. Okay, so what's the first thing? The guy sells it. I say, okay, so this account is debited and that account's credited. That's right. Now they do this. I say, well, how do you do that? Which account is debited and which is credited? And it's just silence. You can't. There isn't any. Okay, well, what happens is this account is debited and that account is credited. Okay, so if you go back and just take each one step by step, which account gets credited, which account gets debited, make sure it all ties back to your, to the narrative. And normally it doesn't. Normally they can't get past the first one. Sometimes they can get past 1 or 2, very rarely.
I think it was partly because McDonald himself mentioned something about capital flight, like concern about potential for capital flight. But I always thought that was used mostly as a means to say, well, people speculating against the pound.
Yeah, so I was with a guy named White. What was his name? Willard White or something? He was head of I was with Jan Kregel. We were at a international trade conference, central bank conference in Budapest. And we're on a bus ride back with him, and he starts talking about capital flight. If you have a trade deficit or something, floating exchange rates. And I said, well, what do you mean? He says, well, the capital leaves the country. And I go he was head of I don't know, some, major, it wasn't a World Bank, but it was something like that, the IMF or something. What was it? Bank for International Development, I think, one of those things.
Oh, God, that's worrying.
Yeah, so I said, well, if you have Joe in New York and he buys pesos from Jose, in Mexico, and he pays for it with dollars, the dollar account goes from Joe to Jose, but it doesn't go anywhere. It stays at Citibank. And the peso account goes from Jose to Joe, but it's still in Mexico. I said, with floating exchange rates, nothing moves. You don't get any capital flight. I say, how do you even know if you had capital flight? He says, well, the peso goes down or something like that. I said, well, I've seen the peso on an announcement move from, 10% or 5% overnight. There wasn't even a trade taking place. There wasn't any capital flight. There wasn't anything. He said, well, you can tell in the quarterly statements, whether there's been capital flight. I said, well, what you're looking at is whether the names change, but that doesn't tell you whether or why the currency went up or down. That's like a different thing. And he agreed with it, okay? But then I read what he's saying later, and he keeps saying the same stupid thing he was saying before. It didn't it probably registered, but not enough for him to change his narratives when he was in his, formal discussions. And that whole conference was like that. There were just one slogan after another being used in a discussion that didn't tie back to the debits and credits of international trade. This was an international trade conference. Of course, Jan had me there because I would speak up each time. He didn't want to he was with the UN. He didn't want to have that be identified as that kind of person. But he was just grinning from ear to ear the whole time. It's kind of fun to be there. Yeah, so these people in these senior positions do not, for the most part, understand their own monetary operations. Period. They just don't. Now, the Bank of England's a little bit different. The people I've known from there, like Charles Goodhart, they know this stuff implicitly. And a guy named Crocker, who used to be there, he was very good. We were there in the late 90s with some people from the Bank of Japan. They had just started doing QE. And I was talking to the Japanese guy there, bank officer, and I said, so, why would you think this is going to have any effect at all? It's not like there's a line of people looking to borrow yen. If only the banks had, yen to loan. The problem is there's just no loan demand. I said, why? You're buying JGBs from them, adding yen balances to their reserve account. How is that going to change the loan demand? I don't see the channel. And Crocker looks at him and he goes, yeah, what do you got to say to that? And the guy just starts, they can't say anything. So he says, well, this is our policy and we're going to be doing this and we'll, examine the results and see what it was. Well, 30 years later, it still hasn't done anything. But the Bank of England guys were on top of that 30 years ago. The QE was just a placebo. It was just like, where'd you come up with this stupid policy?
Well, I hate to disappoint you, Warren, but our current governor of the Bank of England, Andrew Bailey, has warned us that we might be going back to 70s style inflation soon.
If he's right, it'll be for the wrong reason, right?
Yeah, well, because of the rate hikes.
Yeah. Start raising rates. Yeah, they could cause it, but it helps to have a foreign oil monopolist raise the price from 3 to 40. That's like 10 times. That's like today going from 60 to 600. That would cause it.
On that note, actually, to what extent would a rate hike in the US kind of automatically be followed by a rate hike in other countries?
It happens. It's a good question. I don't know today. You can look back the last time we hiked. I don't think too many people followed. There might have been some. And if you notice, the U.S. inflation started creeping up after the rate hike. And again, they can say, oh, yeah, that was our good forecasting. It's like, okay, whatever.
Do you want to read this one, P? It's from Andy.
Yeah. So Andy Tanner-Smith asks, he's debating with some people on LinkedIn who question my assertion that despite the central bank of the Bahamas calling the Bahamian dollar fiat, it is actually not, because it is pegged 1-to-1 with the US dollar.
Yeah, okay, so that's semantics. It's fiat in that it's just a piece of paper, right? But it's the distinction is between being convertible and not convertible. That's the distinction I would make. Because, fiat's another word like money. Is it money or not? Or what's sovereign, sovereign currency? What's that? So, so I don't use those kinds of words. So I would just say one's convertible and one's not convertible. I won't argue whether it's fiat or not. You just ask them, how do you define fiat? If they define it as a non-convertible currency, then okay, then it's not fiat. But not everybody defines it that way. It's just semantics. And it's not important. It's not. What difference does it make whether the guy wants to call it fiat or not? Who cares? Unless you put other things into that definition or other consequences of, in that argument. There might have been other parts of the argument where that made a difference.
So he's saying, I've explained that it will have been pegged for a reason, and that while decoupling it would be entirely within the power of the Central Bank of the Bahamas, there are compelling reasons why it wouldn't do that.
Why wouldn't it do that?
Well, it thinks it would have no value. It thinks it would be an inflation. It would have no value. They don't understand where the value comes from. And they've got commercial interests that probably want them to do that. So it's usually some commercial interests at the expense of the macroeconomy that causes these countries to do that type of thing.
For all intents and purposes, it's like their economy is dollarized, right?
Yeah, so they say, okay, we're 1-to-1 in the dollar, so our currency is stable. Then you ask somebody over here, Well, the dollar's unstable. They're printing all this money. It's going to hyperinflate. So they're, just because you're linked it to somebody else, it's the argument then moves to the next currency. What's making it stable? So they get this idea that Bulgaria is hooked to the euro, so now they have a stable currency. It's like, okay. But nobody with the euro thinks the euro is stable, right?
So we could say, the Bahamas do have a fiat currency that they issue, but
they have a fixed exchange rate policy. They've defined their terms under which they will issue. They'll only issue it to buy dollars. It's a self-imposed constraint. They will sell it for dollars or buy it for dollars. The problem is, of course, you can't sustain full employment indefinitely, automatically if you do that. And anything less than full employment, you're taking away from your real national wealth. So you can't optimize your national wealth with a fixed exchange rate.
But like we've said, that they can't just lift the peg and with no consequences. So they are where they are, I guess.
Yeah, there are a lot of countries now that have those kinds of pegs. Before I could only think of a couple. Now that you mention it, there's a few more.
Okay, and we have another one from Andy. Andy's asking if we accept, and I do, that public sector debt isn't really debt at all, but just the difference between money that's been spent into existence and money that's been taxed out. Why does the government have a line item for interest payments on this debt on its central government expenditure tables?
I think it's good policy to do that. It's a policy choice. Look, it is debt for accounting purposes. What is owed? So you have dollars in a treasury security. And what does the Federal Reserve owe you at maturity? It owes you, it's committed to shift dollars from that securities account balance to a reserve account balance. It debits your securities account and credits your reserve account. It guarantees to do that at maturity. So it has that debt. And it also, the dollars are a liability in that they're accepted for tax purposes, which for accounting purpose makes them a liability of the government. The government owes you the right to have your taxes paid with that tax credit. Now, all tax credits are liabilities. All tax credits are, for accounting purposes, a form of debt. So if you have a solar tax credit from the government, that's the local government, that's local government debt.
It's interesting. It says here on the ONS website that he puts in, interest payments on central government debt were 1.8 billion in January 21, 2.1 billion less than in January 2020. Changes in debt interest are largely a result of movement in the retail price index to which index-linked bonds are pegged.
Yeah. And I've been categorically against those in the U.S. issued some. It's like, what are you doing? They say, well, what the guys at the Fed said was, these are these political appointees that need to be given a different kind of work. Well, it gives us insight into what the market's thinking about inflation, where inflation expectations are. Like that $20 gets you a cup of coffee. That has no value whatsoever to the Federal Reserve Bank. Certainly not enough value to, even a hundredth of enough value to go out and issue multi-billions of these bonds and pay interest on. It wasn't my decision. I tried to talk them out of it.
Yeah, and so to Andy's question about, why does the government have a line item for interest payments?
They think it's anti-inflationary.
But they're paying interest because it's this thing that, you and Bill Mitchell both quit. It's basic income for people who already have money.
On a gold standard, you pay interest so that they wouldn't convert the money or whatever it was, currency, into gold. Take your gold reserves. But that's just long, long gone. The floating exchange rate, the whole thing is just entirely inapplicable.
So yeah, I think Andy's question was not sort of what is the function of interest payments, but like I think he was like saying, well, if it's not a debt, how come the government's paying interest to people?
Because it wants to.
Yeah, exactly. Yeah,
they vote. The Bank of England votes on the rate.
Those interest payments, those pounds, come from the same place all pounds come from, right?
Yeah, well, they're just recorded on a bank statement. That's all they are. There's deposits in a bank account at the Bank of England. It's a bank.
Also, it doesn't say here what part of this debt is owned by the private sector and what part of this is owned by the Bank of England, because I'm pretty sure that the Bank of England returns interest payments, doesn't it?
Yeah, it doesn't really matter, because if the Bank of England owns it, that means there's excess reserves, and then they have to pay interest on the reserves, or they decide to pay interest on the reserves. So the total they're paying interest on is roughly identical. The only thing they don't pay interest on is the cash, the notes outstanding.
So what's happening there with QE when, if the Bank of England buys government bonds on the secondary market, and now the Bank of England's holding those bonds, kind of what's happening on the balance sheet there are these.
Well, it pays for them by crediting your account with pounds, right?
Yeah, but they just pay it to themselves, or how does it work?
Well, they look from the economy's point of view. You had pounds in an account called gilts, right?
Yeah.
Now you have pounds in an account called reserves. They both earn interest, I think. So you just shifted your money from a savings account at the Bank of England to a checking account. And what the Bank of England does is really not of any consequence. But what it does is the Treasury pays the interest to the Bank of England, and the Bank of England remits any profits back to the Treasury.
Right. Okay. So it all ends up back with the Treasury.
Yeah. Bank of England's agent of the problem.
Got it. Want to do that last one, Patricia?
Yeah. So that is by Marvin Solberg, and he asks about. I think he means when we discuss Stephanie Kelton's book, The Deficit Myth, and Kate Raworth's Donut Economics. If a monetary sovereign nation used this unlimited currency creation power to fund the job guarantee, a transition away from fossil fuels and other programs aimed at moving society into the donut while also avoiding excessive inflation, are there any reasons to worry about the currency losing value against other currencies?
Can you repeat the question?
I guess what he's asking is, if we fund the job guarantee and we fund all these green programs and we move, the society towards a more sustainable type of economy while also avoiding inflation, is there any reason to worry about the exchange rate?
Well, if you don't have inflation, it means your currency is stable internally. And if you do have an exchange rate fluctuation, it's because the other currency moved, in theory anyway. I mean, not that you can't have some technical thing like China decided to sell all your currencies, so you get a one-time shift and then it comes back or something like that.
If the government decided to fund the job guarantee tomorrow, knowing how controversial this policy still is for some weird reason, is it likely then that the markets might panic in the short term at least and speculate against us, only to then bounce back at a later date perhaps?
Yeah, anything's possible, right? It could go in one direction or the other, depending on what they believe. They're betting on what they think is going to happen next. And the question is, does it matter? So let's say the pound goes down. You probably get labeled a currency manipulator, get punished for letting your currency, because they think it's to your advantage, right? All the other countries in the world. When China's currency goes down, they get yelled at by everybody. Stop doing it. So it's because it's considered to be a good thing. And when the euro went from 145 or 50 down to 100, that was considered like a good thing. That was the central bank, saving the euro by helping the exporters, right? And it didn't even result in any inflation in anybody detected. If they'd had a job guarantee and it went down, it would have been a disaster, right? Because so I don't know. Now, was that dollar going up or was the euro going down? Well, you look at it against a trade-weighted basket. They got all this stuff, but the yen went from 80 to 120, down 50% a few years ago. Nobody even noticed. The Australian dollar went from 110 down to 55 or something. You get these huge fluctuations all the time, and they're not. In the last 20 years, they haven't been considered. They don't even make the news, right? So, and yet these people are all panicked if you're going to get a 5% move in the currency or 10% over the job guarantee. If anything, I think it would fundamentally make the currency stronger. But yeah, in the short term, you can get pretty much anything. What's the worst case if your currency goes down? The nation itself is not poorer. You haven't lost any wealth. You have a distributional issue. People who are depending on imports have to pay more, they lose, and people who make money on exports win. So you get a slight shift of fortunes from people who import to people who export. The total wealth is the same. Total wealth of the country stays the same.
I guess that the UK, I mean, correct me if I'm wrong, Christian, but I think the UK has quite a funny relationship with the pound in terms of they are very sensitive to seeing the pound reducing in value against other currencies.
I remember the pound at $2, right?
Yeah.
The pound was at $2 not too long ago. And then it goes to like 120. So what happened? Did London Bridge fall down or something? No. And now it's back to, what is it, 138 or 140?
Yeah, 135.
135? Okay. So it's back up 20%, so 15%. So,
I think when people can point to like these shifts on a graph and go, look, that's the pound doing badly, like, and they sort of like anthropomorphize it, like it's the poor ailing pound walking along on a Zimmer frame, and but yeah.
Well, they see it as a reflection of the economy.
Yeah. So the idea is to just stop publishing the number, right? Yeah.
Well, there was also this, this Bill talks about it in his book about the 1970s and the crisis and the IMF kind of bailout.
Yeah.
It was to do with a reluctance of the UK to depreciate the pound.
I know. I've seen the documentaries where it was like this dire thing.
Well, China is actually doing it on purpose.
Well, yeah, they're always right, keeping their currency from getting stronger. That's what all the exporters do. That's what the Germans always did. They bought Italian lira so they could export to Italy, not because they thought the lira was a good investment, because they didn't want the mark to go up against the lira. So they didn't want to lose their export markets, because the exporters are in control. It's a minority benefiting at the expense of the majority. Happens all the time.
So there's also the perception that a weaker pound would generate inflation. But if I hear you correctly, Warren, you seem to be saying that it's the other way around, that inflation moves the exchange rate.
It will, but look, a weaker pound would raise import prices probably. Now, whether that is just a one-time shift relative value or that turns into inflation through some domestic indexation or something, those types of things could happen to some degree. But you've already seen it. You've seen the pound go from 145 to 120 or something. What happened to inflation? Did it change much? I don't think so. If it had, we would have heard about it.
I think there was like a one-time shift on Apple products or something like that.
Yeah, okay. So there you go. There's things you can control and things you can't control. And the important thing that you can control is your domestic real output by having everybody working who wants to work, right? Full employment. And so if you do that is your real wealth, your domestic output. Nobody can take that away from you, even if you don't have a currency. Doesn't matter, okay? Then you've got your real terms of trade. Like, okay, what are your exports minus imports? And those things don't change because the currency changes. Okay, what changes is, again, the distribution. Like, I give the example when I was with Bill in Australia, the coal leaves Newcastle in these ships, and it goes to Hong Kong, and the boats come back full of television sets, right? And that's their trade picture. So Australia's real wealth is everything you produce domestically, minus the coal you have to ship out. You don't get to consume that. You got to send it to Hong Kong, plus the television sets that come back. And a boatload of coal will exchange for a boatload of television sets. There's some ratio. And those numbers, the prices, the relative prices, are not determined in Australia. They're determined overseas in world markets. So a ton of coal gives you 100 television sets or whatever. There's some ratio for one television set. That's the ratio, one ton of coal for one TV. You can't. It doesn't matter whether the Australian dollar goes up or down, or whether there isn't an Australian dollar. But what does matter, what the level of Australian dollars does determine, is who has to dig the coal and who gets to watch the television set. Right? So whether the exporters are benefiting more than the importers, that type of thing. So, but that can all be controlled with domestic policy. Your domestic policy is entirely about distribution from, continuously. Your tax policy is about distribution. Your spending policy, the prices government pays when it contracts and buys things and hires people, that's entirely, those are massive distributional issues. So the adjustments in those can easily make up for any change is in foreign exchange that you want to change. You think that the people working whose import prices are too high are getting hurt too much and the exporters are benefiting too much, you can change that. Okay, and that's not a large percentage of your GDP. Usually they don't want to change it because it's normally temporary. People just adjust. There's no political imperative to change it. But it is totally under your domestic control.
It's fair to say also that what drives currency prices is complicated.
Well, it varies. There's compound. There are a lot of different factors.
Yeah.
I don't know if it's complex, but it's certainly compound.
And perhaps, there might be a movement out of your currency.
Sure. No, it's going to happen. It's going to happen whether you do the policy or not. Twice a year, you're going to get a movement in the pound of 20% or something. Whether you have Brexit or no Brexit, or somebody thinks, the Falkland Islands happens or something, you're going to get, or even if nothing happens, something happens in some other country. The U.S. has some problem, you're going to see a movement in currency.
Yeah. So the point is, these are not reasons to not do a progressive policy that's going to increase the nation's real wealth.
Yeah. This is not a reason to have less. It's not a reason to have less than domestic full employment. So let's do that first, and make sure we're not doing anything that's going to hurt your exchange rate. Now, a job guarantee gives you a higher level of price stability, so it's a force making your exchange rate more stable. So why would you want to not do that? Okay, you have more output, more price stability. It's better than unemployment for both of those. Compared to unemployment, it's a win-win situation. So why would anybody choose unemployment over a job guarantee if you've got more price stability and more output? It's just like, this should be a choice, right? If it's something about the currency going up or down, or more price stability versus unemployment, the price stability, the currency thing's going to be worse with unemployment because you have more price instability. So if you have more price stability, that promotes stable currencies. So, it doesn't mean it's always going to be stable. It means you've implemented a policy that promotes stability rather than works against it. It's like, why are you not doing this? There isn't an earthly reason to not do it except you don't understand monetary operations. It's just sheer ignorance. And so if you look at all the policies, you can see which ones promote price stability and which ones don't, which ones promote output and which ones don't. And then you can steer yourself that way. And the deficit is secondary. And because that's just a tool to optimize these other things, which are what counts. And then if you're going to get any externally generated price instability, okay, you want to make sure you're as well protected as you can. So one way to protect yourself is to have a job guarantee instead of unemployment. So if we all agree with that, well, let's do it. Then why are we talking about the currency? When either way, the job guarantee wins. So let's stop talking about the currency. Unless you want to make the case that unemployment's better for the currency than the job guarantee, I don't want to talk about it.
Yeah, no, that's probably a great note to leave it on. Unless there's anything that hasn't come up that's sort of like something you want to get out there, Warren.
The money story. People say, what's new about MMT? What's different? MMT has 4 solid contributions to, let's say, the history of thought. Not that nobody ever thought of it, but none of the current schools of thought incorporate these things. Number 1 is the sequence. Spending, the funds to pay taxes come from the government, so you can't collect the tax until after you've spent the money. So that sequence is critical. And